All right, so today what I'm going to teach you guys is how do you actually trade your way to financial freedom, right? Because financial freedom is nothing more than making your money work for you so that whatever money you make makes more money to cover your monthly expenses. So here's the goal. The goal isn't to get rich, right? Rich is just a very subjective term. The goal is to break free of the rat race. Most people here are working a job because they have to pay the bills. But what if you were able to learn a mathematical formula where the money that you're making from your investments is actually greater than your bills, meaning your rent, your food, right? This is the key to financial freedom is when your passive income is greater than your monthly expenses. Most people rely on a job to pay the bills, but if they get fired, they get laid off, the income stops. The rich and the wealthy, they have their money working for them so that they don't have to work for it. They don't have to have a job because they have already created their own business. Their business is making their money grow. And the great thing is, money doesn't sleep, right? You can only work for your money 8 hours a day. Your money works 24 hours a day because there's so many different outlets and investments that you could put it in. So the solution is to make your money work harder than you work for it. And you're going to build a machine, a system that can pay the bills and therefore start building wealth long term. So, step number two is where are you going to put your money, right? There's so many different options. People want to take your money left and right. The first one is banks. Well, you can't get rich off the bank. Remember, there's a difference between growing your money versus generating income from your money. I'm here to teach you how to generate income. So banks is safe, but you can't make money. You could put it in real estate, but guess what? If you invest in real estate, that could generate income if you're renting it out and the rent covers your mortgage. But oftentimes people can't do that, especially in the Bay Area. And you need a lot of money to buy real estate, right? You need 20% down payment. So here in the Bay Area, if you want to buy a $1 million house, you have to have 200,000 just to start off with. You could buy stocks. Again, you need a lot of capital and it doesn't generate income. And they're pretty much 50-50 on the odds. So the only way to actually generate income is to learn options. And options is nothing more than a bet on a stock. And because options are bets, they actually expire. And the difference between a bet and just buying a stock is that you could buy a stock and hold it forever. You could just buy it and even pass it down to your grandchildren. With options, they expire, meaning there's a winner and a loser by a certain date. So if you make the bet, you either win if the stock goes past a certain price or you lose if it doesn't. Well, guess what? I'm going to teach you how to sell these bets. Would you guys agree that most people are gamblers? Most people buy options. They're gambling and the math is working against them. But if you want consistent income to generate income consistently, you need to learn how to trade like the casinos. And the casino is in the business of selling probabilities, just like selling insurance, right? Let's say you have home insurance, car insurance, life insurance. Well, guess what? The richest companies in the world are insurance companies and casinos. That's why they have the biggest buildings, the highest skylines in New York, in San Francisco, in Chicago, because they're in the business of math and probabilities. And that's what I'm going to teach you is the only way to actually achieve this financial freedom is to be able to generate income that is greater than your monthly expenses. Once you reach that point, now you are financially free. So, if this sounds interesting to you, the first step is you need to start off with some money. You need capital, right? You can't make money with no money, and you can't make money without taking risk. Would you agree there, Enzo? You got to take risk in life, right? Without risk, there's no reward. So, for you guys as my high school class, a lot of you guys are still young. You guys have very little risk because you don't have to pay for a mortgage. You don't have to pay for rent. You don't have to pay for food. You don't have to pay for your car insurance. A lot of times your parents cover all these expenses for you. All you have to do is go to school. That's your job. And if you have a part time job, you could actually save $5,000 in a very short amount of time. Let me show you guys. Let's say you want to start investing your money and you want to save $5,000. I'm going to show you how you can grow $5,000 to $50,000 in less than 2 years using an income generating strategy. So, how do we save $5,000 if I was a high school student? Number one, I would find a job. We know right now jobs are going for about 20 bucks an hour, right? So if you are making 20 bucks an hour working at Pottery Barn, working at In and Out, then how many hours do you have to work to save $5,000? Well, check this out. $5,000 divided by $20 an hour, you only have to work 250 hours. And assuming that you're working 8 hours a day, right? You're working 8 hours a day, and let's say it's the summertime. You want to work at Great America before it closes in 2027. Do you guys know Great America is closing next year? Do you guys know that? So make sure you guys hit up Great America before it closes, because once it's gone, then you got to go to Six Flags or Disneyland, which is a lot more expensive. So check this out. You divide this by 8 hours, and now you only have to work 30 days. Once you have 30 days, you can save your money, and now you can start investing it. And remember, using the power of compound return, especially as a student, right? Because you don't have bills to pay, you actually have time on your side, because we all know the power of compound return is that once you're young and you can save your money and allow it to grow and compound on itself, you can grow $5,000 to $50,000 using the rule of 72, right? Rule of 72 just tells you how long it takes for your money to double. Hey, I'm speaking. Hey, what's up? Yes. Got it. Okay, bye. Tony. Tony, go to Miss Guzman's office. Who? Miss Guzman, the counselor. All right. So the rule of 72 just tells you that if you were to earn, let's say, 10%, right? Let's say you earn 10% return. That means if you divide it, 10 divided by 72 divided by 10%, which is 0.10, is 7.2 years, right? Here, 7, whoops. The decimal should be right here. I'm a math teacher. I should know better. 7.2 years for your money to double. But guess what? You guys don't want to wait 7 years for your money to double. That's too long, right? We're young. We want to live fast, right? What if I said you could do this not in years, but in months? So instead of 7 years, you could double your money in 7 months. Well, how do you do that? Well, you got to create a strategy that returns 10% per month. Well, you're like, well, Mr. Fam, that's kind of crazy. How are you going to return 10% per month? Well, let me show you. I'm glad you asked. So, what if I said you had, let's say, I don't know, let's make the math easy, $10,000, right? And you want to earn 10% a month. Well, what is that? 10% of 1,000 is $1,000. You guys agree? Oh, my bad. I forgot. You guys, we're using $5,000 because you guys are in high school. Let's say you save up $5,000, right? From working at Great America for 30 days. Now, your goal is to earn 10% a month. What is 10% of 5,000? Anybody know? Allison, what's 10% of 5,000 in your head? All right? You just divide it by 10. Take away that last zero. That's 500 bucks, right? Let's see. Can you generate $500 a month? Most people say, well, that's kind of aggressive. Well, let me say this. Well, $500 a month, right? How much is that a week? Well, there's 4 months and 4 weeks in a month. So divide that by 4 weeks, Now let's see how much is that a week. Well, what's 500 divided by 4? That is $125 a week. Make sense? All right. Well, how much is that a day? Well, there's 5 days in a week. Divide that by 5 days. Well, now look, you're only having to make $25 per day. Interesting, right? Doesn't that seem a lot more reasonable? If you can make $25 a day, that is the equivalent of making $500 a month, which is equivalent of saying 10% return per month, which is equivalent of saying doubling your money every 7.2 months, right? You're doubling it in months, not years. So what is that equivalent of saying? That is the same equivalence of this. Remember I told you I can show you how to grow your $5,000 account, right? And let's say we want to grow it to 50,000, right? Let's say that's our goal, because guess what? Once we hit 50,000, you are now financially free. You're like, well, what do you mean? Because look, what's 10% of 50,000? Isn't that, you just take away the last zero? That's $5,000, right? If you make $5,000 a month, is that greater than your monthly expenses? It is, right? Because especially if you're younger, if you can generate $5,000 every month to pay your bills, now you don't have to work. You don't have to work for a job. You have your money working for you, growing at 10% per month. Okay. So this is the end goal. You want to begin with the end in mind. So we already said, using the rule of 72, that we're going to double our money. Let's just say every 7 months. Okay. So our 5,000 is going to grow to 10,000 in 7 months. This is 7 months right here. And then our 10,000 is going to grow to 20,000 in 14 months. Our 40,000, our 20,000 is going to grow to 40,000 in 21 months. And then our 40,000 is going to grow to 50,000 in 24 months. We're just shortcutting it. So what is that? That's a 2-year plan. Isn't that crazy? I can show you how to actually generate income so that you can meet your financial goal in 2 years. But how do we do this? We need to educate ourselves. We need to learn 3 main concepts. Number 1, we need to learn, whoop, that's way too big. We need to learn specialized knowledge, learn a strategy that generates monthly income. And what is that strategy, folks? We're going to learn how to sell options. What does that mean? We're going to learn how to sell bets like a casino on stocks. Also, the same way of thinking of that is selling insurance on stock. And as long as the stock doesn't get into an accident, you collect the premium month after month, because options expire every 30 days, every 20 days. They even have options that expire 0 days to expiration, trading the SPX or even Tesla, right? And what you'll see is I'll show you strategies where you can generate daily income. If you want to learn to trade for a living, where you're creating 10% every day, right? And these are all strategies that are available out there, but most people don't learn them, or they don't know where to learn them or how to learn them. And that's what my goal is. My goal is to give you the proper education so that you can then use the math behind that to trade like a business. That is the main goal, is you want to trade like a business so that you're generating income just like a business, where your income is greater than your expenses. Next, you got to master the tools of the trade, right? So, yes, first you learn a strategy, then you got to master how do you enter the trades? How do you buy a stock? How do you sell an option? How do you buy an option? You got to master your trading platform. And then the third part, which most people have a hard time doing, is finding a mentor or a coach, right? And that's where I come in. As your mentor or coach, you got to find somebody that you can trust, somebody that's already done it, been there, right? Just like if you're an electrician, you want to go with somebody that's been on the job for 20 years, knows the ins and outs of that job, and can show you, because they can show you how to shortcut your learning curve. If you try to do this on your own, and try to learn strategies and get overwhelmed by the amount of information and grifters that are out there on YouTube, you're just going to end up spending more time, more money, and not reaching your goal. My value comes in where I've been there, I've done that. I've traded for over 20 years. I'm a math teacher. I know the math behind options. I know where the edges lie. They lie in selling options because you have three main edges. You have time decay, because when you sell a bet that expires, that bet is going to decrease in value just through time decay if the stock doesn't do anything. You also are going to use volatility. Volatility is basically a short form of saying fear. You're going to sell fear in the markets because fear reverts back to the mean. You cannot have elevated levels of fear for a long period of time. So you're going to wait for it to revert back to the mean, and you're going to benefit from vega, which is volatility. And then third, you're going to sell probabilities, right? And probabilities is nothing more than a bell curve. And using math, because my background is as a math teacher, you can actually look at a bell curve and predict the probability of a stock staying within one standard deviation from the mean, right? This is where the math comes in, because if the math doesn't make sense, class, it doesn't make money, right? So that's what I believe. Let's say Apple's at $100, right? If I say, well, if I can trade where the stock, all it has to do is stay within one standard deviation, I can actually sell this option and sell this option, collect both premiums, and just wait for time to expire and collect the bet. This is called the probability curve, and this is what standard deviation is. The higher the volatility, guess what? The wider the standard deviation, right? The standard deviation might go from $10, maybe now the upper is 120 and the lower is 80, because there's earnings coming up, right? And that earnings is going to cause more fear, which is going to cause the option premium to inflate in value. And this is the time that you want to sell, right? You want to sell when options are inflated, when there's a hurricane approaching, because you're able to sell that insurance policy for a lot more and just wait for that premium to decrease or deflate, and then you make money off of volatility and time decay. Remember, the two richest companies in the world are casinos and insurance companies. Why is that? It's because insurance companies and casinos are in the business of selling probabilities. So remember, this is what we talked about. We don't need to predict where the stock is going to go. We are in the business of probabilities, which is predicting where the stock will not go, right? So this is the key difference. Remember, to generate income month after month, all you have to do is choose strike prices or bets where the stock will not go to, right? If the stock doesn't go here, I win. If the stock stays within this range, I'm the winner. You could create all types of trades using risk, reward, probability, and payouts. And one other thing is, because I believe that the math has to make sense, let's say you place 10 trades or 10 bets to generate income. Remember, you need to have the probabilities on your side. Let me ask you this. Can you make money if you're only right 30% of the time? Right? What's 30% of 10? That's 3. Let's say you only have 3 winners. That means you have 7 losers. Do you guys agree with that? Can you make money winning only 3 times and losing 7 times? Most people think no, right? That's what most people say. But what if I told you the math says you can? Because look, let's say every time you win 300. But every time you only lose 100. Now, can you make money being right only 30% of the time? The math says you can. 3 times 300 is 900. That's your income. Your expenses is 7 times 100 is 700. So your net profit is actually $200. Do you see that? This is how you could actually make money. This is called expected value. This is called a positive expected value. All right. And what that pretty much is a fancy way of saying, do I have a mathematical model that says if I play this game enough times, will I have a positive expected value? The answer is yes, right? So after every 10 trades, I can expect to make $200. Or if you want to make it a weighted average, right? Divide this by 10. If you divide this by 10 trades, the expected value per trade is $20. This is the casino edge right here, folks. The casino and the insurance companies have a positive expected value of $20, meaning every time a gambler comes in, the expected payout is 20 bucks that they're going to make. Not the gambler, the casino, right? Most gamblers walk into it with a negative expected value, right? A gambler has a negative expected value. But the casino is has a positive. And this is the edge that we're trying to exploit as the premium seller. Because when you're selling premium as an option seller, you have the house edge. And what is that? It's like when you bet on sports, right? When you're playing sports, let's say you bet on the Seahawks to win the Super Bowl. You have to bet 110 just to win 100. Did you guys know that? That's called the juice. A lot of people, they call it the VIG, right? When you're in the sporting gaming industry. This is called the VIG or the juice. Well, guess what? When you are in the business of selling options, your VIG and juice is theta, which is time, right? You're selling time, and vega, which is you're selling volatility. Because volatility or implied volatility is overpriced, typically implied volatility is greater than realized volatility. You have that edge and you're selling time. Time is both of these combined is what's called extrinsic value, right? Because an option has intrinsic value or extrinsic value. Intrinsic value is the actual in the money that it's worth. Extrinsic value is just time and fear. So by selling that and having the mathematical edge on your side, now you can use that as your mathematical model. But even so, most people will still lose in trading because you might have the model, but they don't have the discipline to actually follow that mathematical rule. Not only do they not have the discipline, but most people cannot stand being wrong 70% of the time. I mean, ask yourself, can you be in a trade with your real money on the line and lose $100 7 times and only be right 3 times? No, right? That's why I created a method that overcomes your mindset. What if you could sell option premium that has an 80% chance of being right and only a 20% chance of losing money? In this case, every time you're right, now you make $100, right? But every time you're wrong, you're going to lose $300, right? It's called probability and payouts. Expected value is based on the probability of an event occurring and the payout tied to that probability. So 8 times 100, you have $800 of income. This is the premium that you collected. You pay out the losers, the stocks that actually got into an accident, and you still net $200 of profit or $20 expected value per trade. Does this make sense, guys? Remember, if the math doesn't make sense, it won't make dollars. So, this is the business of selling. You are basically going to learn the business of selling insurance. It's called TOMIC, TOMIC. That's an acronym for the One Man Insurance Company. And you're just selling insurance on stock. Or another way of thinking of it is you are the one person casino. You are selling bets on stock with high probability on your side. That is the framework that we're going to be working with. And if you guys are interested in learning how options are priced, how to use this price to your advantage, that is what's going to be the trader's edge, right? IV is over realized, it's greater than realistic. Remember, in probability and in math, I always talk about three things with my students, right? With my students, there's what's called theoretical probability. And theoretical probability just says when you flip a coin 10 times, you have a 50-50 chance that you're going to get heads or it's going to land tails. That's theoretical probability. But experimental probability is actually doing the experiment and seeing what the actualized probability is. Let's say experimental, let's say you got 7 heads and 3 tails, right? That is possible, right? So therefore, you need to ask yourself, if the probability doesn't work out in the short run, we use what's called the law of large numbers. And the large of large numbers, another way is the central limit theorem, means that the more oftentimes you do an experiment, the closer it's going to be to your actual theoretical mathematical probability, right? So if you are going to now toss a coin 100 times, right? Now it's going to be maybe 55 times it landed heads and 45 times it landed tails, right? If you do it 1,000 times, then it might be closer to like 510 times it landed heads and 490 times it landed tails, right? So the more often you do an experiment, the more it's going to approach the actual theoretical probability. And that's what the business of trading is. The business of trading is not trying to judge yourself on any one trade, right? The business of trading is doing it again and again and making the edges work out in your favor, letting the probabilities play themselves out. And so that's what I'm going to teach you in the coaching lab. I'm going to show you how to actually apply the theory of options trading and more specifically selling options versus the actual realized. I'm going to walk you through 10 different trades so that you can turn the probabilities into profits, because that is basically the business we're in, is selling probabilities and turning them into profits, taking advantage of our edges of implied volatility, time decay, and making sure that we close our trades before the game even expires. It's called cashing out. Whenever you bet on a sporting game, you don't have to hold your ticket all the way to the end of the game. You could actually cash out, right? Let's say Seattle scored a touchdown, or in this case, the Super Bowl, a bunch of field goals, right? You could actually cash out your ticket, and instead of getting the full value of $100, you might cash out for like $60, right? Because the probability of the Eagles winning, the Seahawks winning increased way more. Now maybe they're 80%. You could cash out and just take the money. Same thing with options trading. You can actually cash out of the ticket, buy back that option when it's worth a lot less, and then just take 50%. And that will increase drastically your probability of success. These are the edges that we play on. So once you understand the framework, the math, then I'm going to show you how you can actually sell options and limit your risk. This is called spread strategies, right? A lot of people, you probably heard of naked options. You heard options are risky. Well, options are risky when you're just buying options or you're just selling naked options. But what if I told you you could actually create strategies where you have an 80% probability of success and you're limiting your downside? It's called defined risk trading. And what defined risk trading means, you have a probability of making, let's say, $100, right? And the most you could ever lose on this trade is 400 if the stock goes way against you. But you don't have to take the full $400 loss. You could take $100 and you could cut your losses maybe at 200, right? This is called hedging, where you sell an option and then you buy a cheaper one just to hedge yourself. These are strategies that you're going to learn inside the trading classroom, which is going to be on the YouTube channel. And you're going to see me post these. And if you guys want to see me actually trading it, you can subscribe to the trading room, where I'll walk you through step by step my actual trades. So we are in the business of the expected value. That's our business plan. This is the mathematical formula, and the rule is to make sure that you calculate what the expected value is per every trade, and then you're going to repeat this process for 20 trading days to predict what your monthly income is. And experimental probability is actually the law of large numbers, making sure that we place enough trades so that our account can even out, right? It's going to have periods of high probability profitability, low drawdowns, but in the end, it's going to follow this theoretical probability where your equity curve is growing. And that is another way of saying law of large numbers, right? If you just place a few trades, yeah, your data is going to be all over the place. But the more trades you place, the more it's going to get to the expected value. And that's what the casinos do, and that's what the insurance companies do. And then once you get into more advanced theory, I'll teach you how to roll positions, how to even increase your strategies even more by adjusting losing trades and turning them into winners, or minimizing your losses, and then taking advantage of volatility by earnings trades, as well as other types of trades that you can use with these strategies. So hopefully you guys learned a little bit, and I hope to see you guys subscribe, like, comment what you want to learn, and I'll give you all the information that they don't give you on the markets. Bye.